right now.
Okay. Yep. Hi.
Hi. How
Good
are you?
morning, everybody.
Good morning, Michelle. Nice to see you.
Nice to see you all.
You having a good summer in Santa Fe?
Well, we've had lots of rain, so that's been nice because it was
Okay.
so dry coming up to the summer. It was like unbearable, actually. So we're
Okay.
very happy here.
Okay. So, what's on your radar going
Oh,
into the
well,
Fed?
yeah. Well, summer vacation's on my radar right now. It's probably a really good time for people to start planning, maybe getting away for a few weeks to
You think we're going to
sort
have
of sit.
another dull August like normal, with people really not going back to school until after Labor Day?
Well, we've always taken a holiday in August, and I would say not every single year, but mostly it's a really good time to go away
Yeah.
because it is a time when people take vacations. It is a time when the market is trying to figure out what it wants to do. And we are so ingrained, not just in this country, but all over the world, that September is a fresh beginning.
Yes.
Look, in Europe, they all go away in August. That
Right.
I don't think you really miss all that much by taking a break and coming back to start anew in the fall or the beginning of the fall anyway. Number one. And number two is it's always good to take a break. And I would
Yeah.
imagine that traders are pretty tired at this point. I know I certainly am, in that it's really been interesting. I've had a good year, mind you, but it's been really, really takes 5 times more concentration and commitment to really stay positive in terms of your P&L on this year. So I
A lot of
congratulate
intensity.
anybody who's managed to do that. I'm not talking about day trading. I'm
No,
talking
but
about people like me who do more swing position trading, or even if
yeah.
it's even more active than typically.
Yeah, well, it takes a lot of intestinal fortitude to hold positions in these markets where you sometimes don't have 2 days in the same direction in a row.
Absolutely.
Being a
So
position trader, you really have to have conviction.
yeah, and as a result of having conviction, we've had a pretty good year. So would you like me to share my
Sure.
screen with everybody and we can
Yeah.
kind of go through? Okay, so I'm going to bring my trade station over here. I don't know what happened
So
to
the market bottomed right around the solstice. Okay, that's GAN thing. It was the beginning of summer. Do you think it has legs to follow through the rest of the summer, and then we're going to see what that September is going to be an important month. The last quarter is going to be
okay,
important.
I'll answer all that, but first just answer me. Can you see my screen?
Got it.
You got it? Okay,
Yep.
cool. Well, what's so interesting is this is, guess who these are? My friends,
Yeah, your
my
family.
economic modern family.
Yes.
And what's been so interesting about the economic modern family is it was back in November, and I don't remember if you and I spoke near this period of time, but back in November, obviously, we could see that the 50-week moving average was starting to break in the key areas, which would be retail and in also IWM in the Russell 2000. And so that was really our first clue that things were going to deteriorate in 2022. And this is long before we were really starting to see, Fed was already talking about doing some kind of tightening, but it hadn't really officially started yet. So that's why I like to look at the people, and I know I call them people because to me it's grandma and grandpa, but it's good to look at them to see our clues for what's happening going forward, because look how technically beautiful they were.
Yeah.
Not after it broke down under the 50-week, literally we've been in a trading range market in that we get a range for a week or 2 or 4 weeks or even 6 weeks. We break that range and only to go establish a new range. And in this case, even though we went under the 200-week in XRT, we're
Pretty
back above it.
close. Yeah.
Yeah,
Yeah.
exactly. So essentially, right now, we have to watch this sector. Obviously, Walmart was, we don't know yet whether Walmart was some kind of a precursor to the disaster as we start to see more retail earnings come out, especially this week with Amazon and Apple and Google and all the areas that people go to. But or if it was just some aberration because of the way Walmart had been operating on its own. We don't know that yet. So that's why it's so important to watch here what happens with XRT. So if we put a little perspective on it, and we go back to pandemic levels, essentially what we're looking at right now is a couple of things that are positive and a couple of things that are more concerning. And I'm going to try to stretch this out a little bit. So essentially what we're seeing right now is the thing that's concerning me is how deep a slope is on this 50-week moving average. So it's telling you that even though it has stopped here at the 200-week moving average, that it's actually still has some issues when it comes to momentum. Obviously, we can see that we're not developing a lot of momentum. On the same token, we've really been in this range between like 65, let me get this out of the way. Well, really, I guess we can even say 68 to 70 down to this 56, 57. So when I talk about it, and I'm one of the very, very few people out there who uses the word stagflation. I'm really actually almost amazed. Either I'm totally out of my mind in thinking that we're more in a stagflation environment than the classical recession. But when you have high inflation and an economy that could slow a lot more, let's face it, it's not like I'm saying the economy can't slow a lot more and go into a recession. But at this point, looking right here at XRT, what's somewhat encouraging is that this reflects the slowdown and reflects more of a stagnation than an actual massive destruction. And I love how the demand destruction is something that we're hearing over and over and over again, but it's not really being reflected completely here other than the fact that we have fallen from the peak, which we should have, but we haven't exactly gotten to the point now where we're even anywhere near the pandemic pre-highs, let alone what happened after the pandemic and the stimulus started coming out. So that tells me
you could view it as almost a correction of the advance from the COVID low.
Yes,
pretty deep, right?
And some kind of awakening to reality of we couldn't sustain on 0% interest rates without doing exactly what we saw, which was spiking inflation. People were home and getting stimulus money, so basically getting paid to be home. And even though that's not necessarily happening, what's so interesting right now, and this to me is the crux. I was saying this long before the government has come out and said, we have to really look at the definition of recession and stretch it. It is stretched because the labor market has changed. It has forever potentially changed from a situation where people are not necessarily going back to work or they're quitting their jobs. We know the participation rate is very
resignation. They're not coming back.
Well, and
I want to know one thing. How do they pay their bills? Are they still trading Bitcoin?
Well, I think there's definitely a retail market in trading, because the retail market has gone up to over $25 billion worth of assets of retail traders. So whether or not that sustains remains to be seen. But what's happening is a lot of people are actually, first of all, deciding really how much they can live without. So, that's where the recession fears could come from. But at the same token, they are also doing things, especially the younger generation, more cooperatively. So people are, basically trying to figure out how they can live as cheaply as possible and together as possible. And that's been a trend. But more importantly, I think it's, in a sense, sort of a soft revolution in that, hey, why should I bother to go work? Because even if I go make a living, it's not going to be enough money to match the cost of inflation right now. So why bother? Why put in 40 hours a week and still not be able to afford all the things that I need to do to feed myself or feed my family?
To be able to afford some of the things.
Some of the things, right, exactly. But people aren't thinking like that right now. I think that people are still thinking that somehow if they just sit this out,
they'll get checks.
They'll get checks. Exactly. I really believe that. And it's interesting, but it doesn't matter really. That's irrelevant. What's relevant here is what we see right now is that stagflation, is that we're, like I said, could we go into more?
It's broken.
Right, exactly. And could we get lower prices in the retail sector? But even if we went all the way down to 47 or 50, I think this is a type of market where mean reversion traders are doing the best. Because if you sell the extreme moves up and you buy the extreme moves down, when you get the signal, and if you know how to do mean reversion, it's not so hard to figure that out, you're making some money. And that's basically what we've been doing with equities. Do you know right now, Dale? The only equity we own, we were in a few, but we've taken profits on everything already. And that was after that June bottom was established, is China. We have JD.com, and we're maybe looking to add some more Chinese names. But anyway, let's move on because
you're the perfect person. I've asked this question before, what it means. I believe in the trade of being long IWM against almost any other index. And I was always taught that IWM is the more speculative part of the market. And, perhaps this outperformance in the Russell could be indicative of that we might have one more spec leg left in the market. What does it mean to you that Russell may continue to outperform everything, the mega caps, S&Ps, Dow, everything?
Well, if we just look at what the Russell 2000 is, basically, it's a reflection of the industrial manufacturing side of the US. And we know that that has been an underperformer against big tech for years because there's been no real investment of growth into this country. I mean, just look at infrastructure alone, and we can see how behind we are from, let's say, Asian countries. If we look at solar technology, China's so far ahead of us. And so it's actually almost been somewhat of an embarrassment in this country how little money we have paid towards creating a better infrastructure for the United States, a better industrial manufacturing sector for the United States. And instead, the money has really gone basically to corporate profits and corporate buybacks. So if the Russell 2000 can actually get some legs, I would change my mind about everything. I'm a little bit suspicious about that right now. But again, if we go back to 2020, we held, a little bit beyond it, but this was a perfect mean reversion type situation, right?
Yeah,
we had a really down week. We got into all the support here from 2020. The next week we have an up week. Once you started to see some kind of a dip buying coming in, this is really where it was time to get long. And if you are still long, I think you have a good opportunity to stay long as it keeps above this 200 week.
Yeah, but might Dale, go for your blue line, another mean reversion trade, right?
Exactly. If we can't hold above 176.80, 176.50 in IWM, I wouldn't be all that optimistic about. I would see the next dip maybe would come down to about 150, maybe 160. That area.
So you even know where you're wrong on it. And here's a classic example. So most traders, Michelle, they would say since they didn't buy it before the breakout, they're late. But what you're saying is now they have confirmation and a level on which if they do get long, they get out of the way. So it's a better trade now than it was at the low.
Well, you certainly do know, right? In a sense, yes. I mean, we have a lot of things on our radar. What we are very cautious, though, during earnings season. We don't like to buy ahead of earnings. So there's a bunch of stuff on our radar. And maybe we should go through that.
It gives me Spielke's earnings season.
Well, I just want to show you what a classic mean reversion looks like so that it would be really helpful for people to know what I'm talking about. So I have to get this out of the way. Okay, so this is our real motion indicator right here. See this?
Yeah.
So basically you get the dots, which is the momentum, following the momentum. You have these dotted Bollinger Bands here. Then you have a 50-day moving average and you have a 200-day moving average. Yeah. So when IWM was down here making a new low, look how we broke the Bollinger Band down here, right?
Yeah.
Then we came back through the Bollinger Band right after an inside day and then a move higher. So this was really your signal to go long with a stop under here.
Yeah.
Now, this is why I'm saying right now, mean reversion, I mean, when you're in a trending market, I would not say mean reversion is the way to trade necessarily unless you're really active. But when you're in a trading range market, it's really great. So now look at what happened here. You get a move up to the Bollinger Band. We don't quite get through it. We're above the 50, by the way, and above the 50-day moving average here on the daily chart. And once you start to see the momentum break down, it kind of tells you, hey, maybe it's time to take some profit. I'm not saying necessarily get out. Or if you're a short trader, maybe you would say, okay, I want to go short and I want to get out, obviously, if we take out this high. So coming into today, look at that. We had an inside day yesterday.
Yeah.
We're getting a little bit of a mean reversion sell signal here, but we have a lot of support down around that 176 to 176.50 level. So this gives you a couple of choices as a position swing trader. If you've already taken your profits, great. Tighten up your stops so you don't take losses in anything that you have bought. If you're waiting for this week to go by, you've got some great signals to look at. If it fails the 50 and momentum keeps going down, yeah, probably going to get another leg lower. If we can go down a little and hold this, you've got such a tight risk, that might be a good time to go shopping, particularly if there are certain sectors that you like. And that's what we can talk about next, because there are some sectors that I like.
Before we do that, can we talk yields since the Fed is here tomorrow?
Yes.
Like the 10-year, I think is the strangest setup, Michelle, at this 275 level on the verge of a breakdown in front of the Fed. Because if the 10-year starts closing under 270, it looks like 220 coming. So
Cool.
there's your there's the bond market. So
right. Well, what's so interesting about the bond market, Dale, is that you know how I love junk bonds?
Yeah.
Junk bonds have been really a great friend to traders if you understand how to follow. Here was your mean reversion in junk bonds, by the way. And I wouldn't say this is a mean reversion because we haven't cleared the Bollinger Bands. This is a pause. But junk bonds right now are coming in pretty much around unchanged, which means they're holding the 50-day moving average. Yeah. You've got the slope on the 10-day moving average going up. You're above the 50-day moving average in momentum. And I wouldn't really worry too much about the bond market, junk bond market in terms of volume. But what this is really saying is that there's still a risk-on attitude. So if you take that, why would bond traders be buying junk, high-yield bonds ahead of a historical Fed meeting where they can go up 1%? Is because they probably feel that the Fed is not going to do 1%. 75%, 75 basis points priced in, maybe even 50 basis points, because we don't know what the Fed's going to focus on here. Powell has said everything from last week, well, if we do one more major hike, that's going to be it. So that's what the market hears. Okay, that would be a great opportunity to buy. Oh, he also said maybe we'll go to 50 basis points and not 75. So I think it's really important to see what the bond traders who are really doing the high yield, high debt bonds are doing, because regardless of all of the talking heads and everything that you're hearing from people saying, oh, we're going into major recession, to people who think that we're going to go into new highs, forget about all of that. To me, this is the most important chart, probably of all the charts I showed you. The others give you great trading parameters. This gives you a macro sense that things aren't as destructively bad as one would think, listening to all the talking heads out there.
You're not worried about credit.
Exactly. I mean, there's not going to be a major default at this point by anybody looking at this. Could be wrong, and we could see this thing go, But until that happens, you know, again, I'm sort of more cautiously, I think we're in a stagflation. I think what this is showing is that things aren't so bad. So we could see that the destruction that everybody was expecting down here, it never broke really 90. 90 was actually a great double bottom. And maybe we can see a little bit more. I mean, do I think we can get to 100? Possibly. Do I think it could go more than that? No. But if you go back to the 70s, this is exactly what happened. We went into that quick recession after the oil embargo in 73, 74. Then things with a more accommodative Fed started to come back. Then
Arthur
76, we
Burns.
started to see a new leg up in commodities. Why?
Right.
Because people got complacent, and the Dow Jones Industrial Average had topped out at 1,000. And really, it took not until 1982, 83 for it to clear that. Yet we had these big swings in there and then a flat line. And I kind of still feel like that's kind of where we're going at this point. So I haven't
Okay.
changed my mind about any of that.
Okay. So well, watch HYG.
Yeah, I know.
And
I put up, I like this one. I just because it's so
oh, okay.
obviously junk,
Oh
it
yeah,
says
that's
junk.
junk.
But
Yeah.
here's HYG. It looks exactly the same.
Yeah.
It doesn't matter which instrument you like to look
Yeah.
at. So
Corporates as well look okay. Sovereigns look okay. TLT looks good.
right,
And
TLT, actually,
yeah,
you would think that, if the Fed was going to be so hawkish. Now, it's
yeah,
not exactly impressive, but
yeah,
it's certainly not falling apart. And by the way, this actually also had a mean reversion to the top. You see how nice that is?
right.
It breaks out of the Bollinger Band, then breaks below. So now I wouldn't trade the TLT ahead of a Fed meeting, but it would
No.
certainly be interesting to see. This could be a big bear flag, and we could see the yields go higher, and that could destroy things for a while.
Or
But
we could
again,
put in a right shoulder. Look at the left shoulder and then the
yeah,
head, and then a right shoulder could
right.
develop on a
And
break.
then we get through 120.
Yeah,
This is where people like Raoul Powell are saying, buy bonds,
yeah,
buy diamonds. I mean, this is where a lot of people think that everybody that says that the yields are going to go much, much higher is, are wrong. Now, with that, you have to ask yourself, with inflation, most recently at 9.1, and by the way, gas prices rising, natural gas prices rising, some of the other commodities have come off, but they're into really major support. You have to say, even if we go to 3.5% yields, right now we're still under 3, or we go to
yeah,
3.25, is that really going to be enough to control inflation? And that's where the stagflation, and I'm, again, maybe one of the few holdouts to think that we're still haven't seen a second wave of a super cycle in commodities. And that's
yeah.
really what I'm watching very carefully right here.
Can we spend the last few minutes talking about commodities, since you believe this
Absolutely.
is most likely a break to buy rather than the end of the bull market in commodities? Am I
Absolutely. I mean,
reading
when
you
people,
correctly?
yes, you are reading me correctly, sir.
Turn the page. Anyway, to commodities. All right.
Well, here we go. Look at DBA. Okay, so DBA
Yeah.
right now, this red line here is a
Yeah.
6-month calendar range low that resets in July. It resets in January. Look how nice it worked in January. It cleared the 6-month calendar range high and had this huge move up. And now here was the 6-month calendar range low. We broke it for like a minute yesterday, and now we're back above. I mean, 2 days ago, sorry, Friday, and now we're back above it. And now this is coming in 77 bid at 85, which means it's coming in up here.
Yeah.
I mean, if you really wanted to take a shot, to me, this would be the better place to take a shot. I could understand if you want to wait for Fed, because obviously if they go to 1%, this could all go away. But right now, you have a pretty good risk to under this low here, which was, without my glasses, I can't see. Does that say 1929?
It says 1910 on the right.
Right here. Wait, hold on. 1929. Oh, wow. That's an interesting
Nice.
year.
Yeah.
So anyway, that's DBA. I would keep my eyes on that. Sugar, which has had a massive amount of destruction here. Look at that. Look at what sugar has done.
Yeah.
But sugar, right now, we'll see what happens today. Sugar can continue to go up. To go down. I'm looking for a mean reversion trade in sugar. We get a mean reversion trade in sugar with all this support that we have down here from the beginning of 2022. And I would say sugar could be a lead indicator for more inflation to come. Want to look at gold? It's been such a dog, but it had an unbelievable move. And let's see if I can tighten this up here. No, that's making it narrower, sorry. I mean, you want to talk about holding support. You had the lows from 2018, 2020, right down here. And now you made a new low. You broke the 6-month calendar range last week. You had a perfect mean reversion trade, a big reversal the next day, a pop. And again, if you haven't touched gold, or if you think gold's going to 1400, you might be right. But to me, the better money right now, and by the way, we're in it, small position, we've got in, based on the fact that this reversal, we would know right away where we were wrong if it breaks down under here, or if you wanted to take a smaller position, but risk wider, you could look at the 200-week moving average. So that's kind of where
Okay.
we're at. Otherwise, I'm really, really interested in some of the Chinese stocks. We're already long JD. You can see this thing is coming in 0.5% higher. We're looking at Chinese solar, Inco Solar.
Why do you think the main reason is because of their central bank easing? That they're
Excellent. Yes.
outperforming? Is it that simple?
It could be that simple. It could also be
Yeah.
the fact that, COVID has still kind of wreaked havoc there. And eventually we know they're going to come out of it. But yeah, if you look at 2008, Dale, when we were crashing, China was rallying.
I remember.
And it's a very similar type of situation because we're doing QT, they're doing QE. And again, you want to look at talking heads. Everybody's going to talk about how China's great world power dominance is dead. No freaking way is that true. No way. I mean, you have some advantages in a sense of the fact that they don't have to have the political process that we have here to get anything done. They want to get something done, they get it done. They want to bail out Evergreen, they bail out Evergreen. They want to keep people happy, they try to keep people happy. They want to squash anything that is anti-government, they squash it. But
doesn't that worry you? Doesn't that worry you looking at their past behavior of doing that? Last year, they were pretty draconian on shareholders like Jack Ma and some other
and I think
multi-billionaires.
Xi realized he made a huge mistake. I think he realized that yes, he'd like to control them, but I also think he made he knows he made a mistake because it drove the economy down along with COVID. So let's take a look at Alibaba because you fell right down.
Did he call
back.
you, Xi? To get the correct
he and I are like buds.
Advisor.
I get my chow fang, and But anyway, look at this. Alibaba has a little bit of a double bottom here that you could trade against. It's up almost 3.5% today. I think if you wanted to take another shot, maybe if we can get through these levels of 106, 107, you got a nice little risk to under here. To me, play China, play South Korea, play the countries that don't have the same issues of inflation or interest rate problems that we have. And in the meanwhile, if you're looking at us, the last thing I want to say is look at the EV space. Ford reports tomorrow. It's probably the most exciting thing I'm looking at right now. If Ford has good report, gets through 13, with mass adoption of EVs, I think we might see a nice little move up, at least, a few dollars here until we take some profits.
Would you short the DAX? One question I just got. For Amira.
Well, right now we have a nice little bottom in place. Here's your 6-month calendar range low. See that red line?
Yeah.
And in terms of the 6-month calendar range high, really you have to look at, it's right here, we're close. So right now, no, I would almost prefer to wait for the weakness or wait for a move up to the 50 that can't clear. You have to know where your decent risk is. I guess if you wanted to go against 24, maybe. But right now,
Michelle is strongly neutral.
I'm strongly neutral coming into this week, which is, I think, the best. Open mind, open mind. Yes.
React to the reaction.
Exactly.
Tomorrow afternoon, right? So, Michelle, best way for people to follow you and get your great intermarket analysis. You're one of the best out there at it. Always have a great time talking to you. Best way for people to follow you at Market Minute on Twitter.
Yeah, at Market Minute is my Twitter. I do a lot of media. I'm on Fox and CNBC and Bloomberg and TD Ameritrade and all the channels constantly. We have a subscription. We have a YouTube channel, which is Market Gauge YouTube channel. You can get to see all my video hits and what I talk about there. And then, of course, if you go to Market Gauge and sign up for the daily, I write daily content along with Wade behind me here, my assistant, every day. Keith does a big outlook with a video and bullets on risk every Sunday. So we give a lot of good free content for you guys to check out and get to know us.
All right, Michelle, thank you so much. Maybe we could have a drink together this week. You know where?
Where? Are you coming to Santa Fe?
At the Final Bar.
Oh, at the Final. Oh, that's right. You're on it this week too.
All right,
yes, good old Dave.
I'll be, huh? But we'll do a real one day before I leave the planet. I promise. Okay.
Okay, sounds
All
great.
right,
Thank you,
Michelle.
Dale.
Thank you so much for your time and great presentation. You never, you never disappoint. So thanks
Thank
again,
you so
Michelle.
much. Okay,
All right.
bye-bye.
See ya. Okay. So Michelle, Miss Schneider at Market Minute, and you could join the rest of the team for the Morning Edge in 13. Everyone have a great day. Remember, don't just count your gold bars or your shares, count your blessings. There's always something to be thankful for. Adios, everyone.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.